When you hear a term like split dollar insurance, it kind of sounds super corporate, maybe a little intimidating, right? But what if I told you it's actually this really flexible strategy that everyone from business partners to entire families are using? Well, today we're going to pull back the curtain and see exactly how this powerful financial team up actually works. So, here's our game plan. We'll start by breaking down what this financial team up really is. Then we'll look at who's actually using it and why it's their go-to. After that, we'll get into the two main playbooks for setting one up. And, this is a big one, we'll talk about the single biggest mistake people make. And finally, we'll wrap it all up with the key things you need to remember. All right, first up, what is this thing really? At its core, you got to think of split dollar as a partnership. It's just a way for two different parties to join forces to reach a single goal, using life insurance as the tool to get there. Now, here's the official definition for you. A split dollar arrangement is a contractual funding strategy where two parties share the costs and benefits of a permanent life insurance policy. Now, the most important words on this whole slide are contractual funding strategy. Why? Because that tells us exactly what this thing isn't. Say, split dollar is not some product you can just go buy off a shelf. I think the best way to picture it is like this. The permanent life insurance policy, that's your financial engine. It can build value, it can provide all sorts of benefits. The split dollar arrangement is the rule book that everyone agrees on for how to use that engine. Who's putting the gas in, who gets to hold the keys, and who ultimately gets the value it creates.
So we've got the what down. But honestly, the why is where this whole strategy really comes to life. Who are the key players using split dollar? And what specific problems are they trying to solve with it? Generally speaking, it really boils down to three main groups. First, you've got employers who are trying to hold on to their key executives. Second, there are business partners who are looking to solve tricky funding issues. And third, you see a lot of families using it with trusts for their estate planning. And each one of these groups has a totally different problem they're trying to fix.
So for a business, the problem might be, how do we keep our absolute best employee from getting snatched up by a competitor? A huge salary definitely helps, but a high-value, long-term benefit like this, well, it can create what people call golden handcuffs, a really powerful reason for that person to stick around.
For business partners, the problem is often about fairness. I mean, what if one partner can put in way more cash for the business insurance plan than the other? Or what if there's a big age gap between them? A split dollar agreement can totally level the playing field, creating a setup that feels fair even when the money going in isn't exactly identical. And for families, the problem is usually all about estate planning. Let's say you want to fund a big life insurance policy inside a trust for your kids or grandkids. How do you do that without getting slammed with massive annual gift taxes? Split dollar gives you a way by using documented loans instead of these huge taxable gifts. Okay, so we know who's using it and why. But how does it actually work under the hood? Well, there are two main playbooks, or regimes as they're officially called, and they pretty much set all the rules of the game. This slide really breaks down the two competing philosophies. Over on the left, we've got the loan regime. The easiest way to think about this one is it's a formal loan. One party advances the premiums, interest is tracked, and the loan gets paid back later on. This is the path you take when the ultimate goal is for an executive or a trust to own that policy completely. Now, on the right is the economic benefit regime. And at first glance, this one feels a lot simpler. There's no loan to keep track of. Instead, the person who's insured just pays a little tax on a calculated economic benefit each year. But here's the catch, and it's a big one. That cost, that benefit, it goes up every single year with age, and eventually it can get so expensive that it just becomes a terrible deal, making it a pretty inefficient long-term solution. So, here's the crucial point. There is no single best answer here. Deciding between a loan or an economic benefit setup really just comes down to one thing. What's the end game? Is the goal for that executive to own the policy in 20 years, or is this just a temporary perk? The long-term goal is what dictates the right playbook. And hey, speaking of the end game, that brings us to the single most critical part of any split dollar plan. And believe me, it's the source of almost every single problem, the exit plan. So let me just ask you, what do you think the biggest risk is? Is it making some tax mistake? Or maybe picking the wrong insurance policy? I mean, yeah, those are definitely risks, but they're not the biggest one. Not by a long shot. The source material really just hits the nail on the head here. Many split dollar horror stories are really no exit plan stories. That's it, right there. The number one reason these things go wrong is because people don't clearly define how the arrangement is supposed to end. What happens at retirement? What if the executive leaves early? If you don't plan the ending right at the beginning, you're absolutely planning for a disaster. So to avoid those horror stories, a really solid plan is always built on these 4 pillars. First, ownership. Who legally calls the shots here? Any ambiguity is just going to lead to conflict. Second, the funding pattern. How is this whole thing getting paid for? And for how long? Third, and this is the most important one, the exit strategy. What's the plan for retirement, or if someone leaves? You have to decide that on day one. And finally, policy selection. The insurance policy itself has to be tough enough, durable enough to survive decades of market ups and downs.
All right, we have covered a ton of ground. So let's bring it all back together and really focus on the key takeaways you should remember about these split dollar arrangements.
When you really boil it all down, this slide gives you that nice, balanced view. The benefits are super clear. It's a flexible way to share costs, it can be a monster retention tool for your top talent, and it gives employers a way to get their money back. But the considerations are just as important. This is not a set-it-and-forget-it kind of strategy. It takes ongoing administration, annual tracking, and like we just saw, getting those exit terms, the unwind, right from the very start is absolutely critical.
Ultimately, split dollar isn't just about insurance or taxes. It's really a tool for partnership. It's a structured way for 2 parties to accomplish something that neither one of them could easily do on their own. And that really leaves us with a much broader question to think about. In your own financial world, when is teaming up on a strategy way more powerful than trying to go it alone?